Hello and good evening. My name is Sandy Robinson. I'm sure I'm familiar to many of you this evening. Thank you for joining us in week 5 of our 8-week Dementia Information Series. Tonight, I'm really pleased to have Michael Key with us to present on taxes and tax information. But just before I introduce him, I just want to mention that next week, week 6, I believe, we're going to be talking about home safety. And the home safety portion will be done by 3 people. We'll have 2 representatives from Halton Police come. Really interesting information on some scams that are happening, how to keep people with dementia safer in their homes, and the Vulnerable Persons Registry, Project Lifesaver, and Vanitha Nair, caregiver educator here, also will be talking about showing you some specific devices that you can use for home safety. So I think you'll all find it really interesting. So tonight we have Michael Key. He is a partner at SB Partners accounting firm in Burlington, and he takes pride in understanding his clients' businesses and offers a collaborative approach to identify key areas requiring focus and helps propel them to greater success. Not only that, he does it with a great sense of humor. I've known Michael since about 2010, and Michael has done this presentation at least twice a year since then. And he takes what has been known as can be a dry subject and makes it very interesting. I also want to mention that you will receive the recording of this session, and you will also receive in your email, you will receive a number of the forms and information and the handout that Michael's talking about tonight. You will be receiving that at some point during this week. So Michael, I'd like to introduce you. You're welcome to come on board, and I will disappear. Thank you, Michael.
Good evening, everyone. Thanks for joining virtually for this presentation. I was saying to Sandy, this is, brave new world. As Sandy noted, I've done this presentation a number of times, but doing it without seeing all of you here virtually is definitely a new experience. I can only relate it to when I was in university, used to do a radio show, but with the radio show, I definitely knew we were talking out into the air. We would have maybe 2 listeners and they were close friends. So thank you all for joining tonight, and I'm going to get everything set up here so that you can see my presentation, and we will take you through tax and related items. So as Sandy noted, I'm a partner at a local firm, SB Partners, here in Burlington. I've been dealing in the tax sphere since I was a co-op student in the mid-90s. Still try and keep my skills sharp on all aspects tax. I am focused very much in the corporate tax sphere and corporate integration for my business clients. But again, this has been something that's been always big to me is giving back to the community, and the focal point of the Dementia Alzheimer's series has always been big to me. Again, a personal connection. My mom used to work for Acclaim Health. She's now retired, but again, she still connects with a number of the Acclaim alumni. So what I'm going to go through tonight is really just, again, I'm going to start with some general tax credits just to kind of give a flavor for, again, just tax in general. And then I'm going to get into a little bit more of the specifics, dealing with specific things that may impact you as a caregiver. That being the medical expense credit, the disability credit, and then the attendant care credit. So the way I like to start is just to kind of talk about the whole idea of tax credits in general. So when we have a tax credit, whether it's a general personal credit or a medical tax credit, these credits, they're to an indexed amount, and that indexed amount is what we use to then multiply by a 15% tax rate federally, a 5% tax rate provincially, and that's what generates a reduction in an individual's tax. So the one that I like to start with that that everyone is generally familiar with is the basic personal amount. So if you've looked at your own tax return, and actually what I'm going to do here is I'm going to show you the area of the tax return that I'm talking about here. Let's just make sure that I've got this up here. We're doing screen 3. I just want to make
Yep,
sure.
you're good.
Sandy, perfect.
Yep, you're good.
Okay, so
Perfect.
again, I'll refer back to this jacket here. If you're familiar with tax return, you've got this this item, basic personal amount. So what does that mean, and how do you relate it to what I'm talking about here in the presentation? So if you look back at my slide here, we've got sorry. If you look at the slide here, I say every taxpayer is entitled to a basic personal credit in the amount of $12,298. In simple terms, what that means is if an individual were to receive $12,298 of income, that individual would end up paying no tax. And the way that's calculated is the government says, okay, you have $12,298 of income. That's taxed at a 15% rate based on marginal tax bracket. So you would otherwise pay about $1,800 of tax on that income. But by virtue of having this tax credit, you're going to get a tax credit of $12,298 times 15%, which gives you a reduction in your tax of about the same $1,800. And if you take the tax calculated and the credit calculated, 1,800 of tax, 1,800 of net credit, you end up with a zero tax balance owing. And so why is it a credit? And what's the difference between a credit and a deduction? When you have a deduction, it's reducing one's income. When you have a credit, it is reducing one's tax. So it's very important to be distinct here, because what happens with a deduction is it lowers your income at the marginal tax bracket that you're at. So if you had an individual that made $100,000 and they had a tax deduction of $12,000, they would be taxed on income of $88,000. Whereas if you have an individual with $100,000 of income and they have a tax credit of $12,000, that tax credit is only applied at the lowest marginal rate of 15%. So it's a huge distinction. The other thing with a tax credit is if you don't use that tax credit, you lose it. So as an example, if I have an individual that has $5,000 of income and they have this $12,000 of credit, they don't end up with a negative amount that would entitle them to a refund. They simply only get to use up $5,000 worth of credit against their $5,000 worth of income, and they end up with a zero tax balance. So just a note here with regards to this slide, we've also got a new top-up credit of an extra $931. So again, take that $931, multiply it by 15% federally. So you're talking about $140 to $150 of additional tax reduction as long as an individual is earning less than $150,000. So again, I mention this simply so that you have an idea of everybody does get a personal tax credit. So everybody is entitled to a tax credit on their tax return. The credits that I'm going to introduce hereafter are more geared towards the individuals that are applicable within the Alzheimer dementia series. So if I'm looking at this, then we've got an age amount. So again, I'm going to note here that you've got any taxpayer that's over 65 is entitled to an additional tax credit of $76.37. So again, that's going to reduce that individual's taxes by about $1,100. This is an indexed credit. That credit, an indexed credit means that as soon as you're over a certain level of income, that credit starts to go away. So if you take this number, $38,508, if you have an individual that has income less than that $38,508, they will get the full credit. As soon as they start to creep above that number, So say we had an individual with $39,508 of income, they would be $1,000 over that threshold. $1,000 times 15% is $150. Their tax credit would be reduced by $150. So they would be left with a $7,487 credit, by which, multiplied by 15%, they would reduce their taxes accordingly. So again, using that incremental, that erosion, once you get an individual that gets over that $89,000 amount, that has eroded the full $7,600 credit. They would get zero age amount. The thing to note with this credit is, this credit, if it's not used, can be transferred to a spouse. So if I go back to our trustee tax jacket here, if you see on the second line below basic personal amount, sorry, I'm just looking at this on a side screen, so I'll pivot forward just so that I'm looking forward. If you look here, you've got the age
Michael,
of, oh,
we see you
me.
swimming in the water.
Oh, very nice.
Is that you swimming?
That's great. Maybe I'll move this back then. I love it. Okay, we're back on.
We're
Good.
back on.
I will leave that. I will leave that there. We'll leave the swimming to the experts. Okay. So we've got this age amount here. And so I want you to consider an individual that only has $12,000 of income, and they are over the age of 65 and they are married. So that individual with only $12,000 of income would only have enough income that they would just use their basic personal amount. They wouldn't be using their age amount. That age amount, and again, I apologize for the indexing on this page. This indexing is based on the 2019 tax forms. We haven't gotten the 2020. My presentation has the indexes for the 2020 tax return. So again, if we had an individual that couldn't use this age amount, but we're eligible for it, that amount can be transferred to their spouse. So again, I always point this out is you'd say, well, okay, this is getting complex, a lot for me to take in. Well, two things. One, your tax software will do this. So unless you're doing your taxes by paper, any tax software will calculate these things. They will accommodate for what's the age of the taxpayer, are they married, what are their incomes, and those tax softwares, even the free tax softwares that you can find available now will accommodate for all of this. So I mentioned this, to be very careful with your calculations if you're doing it by pen and paper or pencil and paper. But again, I don't find many people doing this in any other way other than computer these days. So to go back to the presentation, we're looking at spousal amount. So now again, you've got an individual that has zero income. So you would say, well, okay, that individual can't even use up their basic personal amount. Well, what the tax return allows for is if you have an individual that has no income, that basic personal amount of $12,298 can be transferred to a spouse. So that basically allows that spouse now to have not only their own basic personal amount, but now a second basic personal amount. Again, if they're over 65, their age amount, and again, possibly their spouse's age amount. So you could, in theory, have an individual that's over the age of 65 with no income. They would have about $20,000 worth of credits to be able to transfer to their spouse. And assuming their spouse was under $38,000 of income, they would have enough credits. They'd have about $40,000 of credit to not have to pay any tax.
Michael, I do have a question that came in, and it's on this subject.
Yes.
So it says, so on the spouse's tax for age amount, they can claim it twice?
That's what, well, the way the transfer works is yes, you would end up doubling up on it, right? Okay. So again, if you're using a tax software, the tax software will recognize this spouse doesn't have any income. This spouse can use the credit, and yes, it will move that credit, that second age amount into the tax return.
Thank you.
Okay, great. So other credits that are important to know, there's pension credit. So again, so if somebody's receiving qualified pension income, and that includes foreign pensions, they can receive up to a $2,000 credit. So I'll use the example, somebody receiving a $2,000 RIF payment. So they would have a $2,000 income inclusion, and then later on in the return, they would receive a $2,000 credit, which would reduce their taxes accordingly based on the $2,000 credit. So again, federally, it would reduce their taxes by 2,000 times 15%. So it would reduce their tax liability by $300. Noting that CPP and OAS are not eligible for the credit. So again, it would be foreign pensions, life annuities, as well as RIFs. So, and again, it's very important to note that it's RIF payments, not RSP withdrawals. So if somebody is, say, 65, 66, 67, and they haven't converted to a RIF and they take money out of their RSP, that is not qualifying as pension. Here's where we get into a little bit more of the, I'll call it complex credits. First one here is the Canada Caregiver credit. So this is for an individual who is providing assistance to an infirm relative age 18 or over who is dependent on you for support. So again, what always comes of this is okay, what does that mean for support? And so I did revisit again today because I'm always a bit leery on it myself in the sense of it seems a bit vague. And the terminology they use is some or all of food, shelter, clothing, assistance. So again, how does that get proved out? Well, again, if mom or dad or spouse was living, if mom or dad was living with you and being taken care of, and obviously you're under the same roof, same address, I think it's a slam dunk with this credit. I think if mom or dad was living in a home and you were getting into, well, we're having to buy clothes and what have you, I haven't seen CRA audit any of these types of claims, but I do find it interesting because they would get into the burden of proof on the taxpayer if they decided they wanted to audit. It would, in theory, require an individual to be keeping receipts to say that, yeah, I paid for food for mom or dad, or if I paid for clothes for mom or dad, or what have you. Again, I do find that this credit is very limited in scope, though. I point to the second column here in the slide that says the credit is reduced when the dependent's net income exceeds 17,000, and it is completely eliminated when net income exceeds 23. And I point that out simply because if you look at it in context, if you have an individual that's getting full CPP and full OAS, and I know that's not everybody out there, but if they were getting their full amounts of just that, that's already over $20,000 for an individual these days. And then if you're layering on a little bit of pension income or what have you, this credit really does get wiped out quickly. In practice, I have very rarely seen this credit used. Again, it was formerly just known as just the caregiver credit. And in the time that I have been dealing in returns, and again, I see about 500 returns that come through each year, I had 2 clients that have ever used this credit. Medical expense credits. This is always a great one to go through because most people are very familiar with it. Again, normally I would get a show of hands to find out how many people have ever claimed it, but I generally find the consensus is that most people have claimed medical expense credits on their tax return at some point. And so the starting point for medical expense credits is just to recognize that it's an indexed credit and it is geared to your income. So you'll note here on the slide, medical expenses must exceed the lower of $23.97 or 3% of net income for the year. And again, one would say, why is it $23.97? It is an indexed amount that each year based on consumer price index gets bumped up. So this is the 2020 threshold. The 2021 threshold might be $2,412 or something of that nature that will be indexed. The key part here is the 3% of net income for the year. So if you were to consider a taxpayer that had $30,000 of income on their tax return, $30,000 times 3% is $900. So that would mean that an individual would have to have $900, more than $900 of medical expenses in order to claim a medical expense credit. So if we think about it, we'd say, well, okay, we would have $1,000 of medical expense credits for that individual. So you would say, okay, my threshold is $900, my medical expenses are $1,000. I'm $100 over that threshold, so 1,000 minus 900. I have a $100 credit. So that $100 credit times 15% federally results in a $15 tax reduction. And I know like 15 bucks. I will claim $15. Right? Anything to reduce tax. But I think the other thing to note is that this sentence, they can be claimed for any 12-month period ending within the calendar year. And so why is that important? Well, why that's important is again, people don't get sick in a calendar year. So the example I always use is if you had two individuals, and again, let's use that $900 threshold for medical expenses, and they had something happen to them during the year, and they needed to go in and have two consultative visits. I used to use dental, right? I used to play hockey, and picture you got hit in the mouth, and you need dental work done, and you go to the dentist and they say, well, here you go, we need you to come in and get this procedure done, and it's going to cost you $750, and then we're going to have you come in another 2 weeks later and it's going to cost you $750 again. So you'd say, okay, great, 2 times $750, that's $1,500. I've got a $900 threshold, so I'm $600 over the threshold, so I'm going to get a $600 credit. Fantastic. This rule is in place to punish, as not to punish the person who gets hit in the mouth on December 28th. They go in, they pay $750 on December 29th to get their mouth fixed up, and they have to come back on January the 4th to get the second $750 procedure done. You'd say, well, okay, in year one, $750, they're below the $900, they have no credit. The year two, $750 again, they're below $900, they don't get a credit. This 12-month rule allows someone, so now you go back to my example, in year one, that individual wouldn't have qualified. Now, if you add year two, you'd say, well, okay, they had this procedure done within a 2-week period, they've got $1,500 of medical expenses. In year two, as long as that individual on their tax return picks a period that ends in year two, they can claim as much as what's in a 365-day period that ends in year two. So in my example, you could say, well, someone could pick a date of December 26th of year one, ending December 25th of year two. That's a 365-day period that ends in year two, and that would collect all $1,500 of medical expenses and allow that person to take the claim. I see all the head nods, but I don't see any of the head nods. So I'm just going to know that everybody is doing a great job of picking all this up. So what you should know about medical expense credits. Medical expenses can be claimed by either spouse, for dependents, or for relatives who are dependent on you during the year. So let's start with the first one, by either spouse. And again, I'm going to use the same example. I'm going to have two spouses, and they both have $30,000 of income. So they both have a threshold for their medical expenses of $30,000 times 3% equals $900. So each spouse is at $900 of threshold, and each spouse has $700 of medical expenses. So you would say, well, okay, each spouse, neither of them is going to be able to claim anything. Well, what's allowed is those spouses are allowed to pool their medical expenses together. So 700 plus 700 is $1,400 of medical expenses. And so that $1,400 is applied against one of the two spouses' thresholds. And so again, if they both have the exact same income, it would just be an arm wrestle to decide who's going to claim the $500 of credit. Usually when we're doing a return, what we'll find is the strategy is simply who is the lower income earning spouse. They will have a lower threshold, so they will have the ability to generate a higher credit. The only flaw with that strategy is sometimes an individual can already have enough credits that they've eliminated all of their taxes, so that won't work. But again, it really becomes part of the tax software that you're using. It's identifying all of the relevant medical expenses and being able to apply them accordingly. So then you note that it says for dependents or for relatives who are dependent upon you during the year. So this is where we get into this dependence piece, where it's, well, what does dependent mean? Are they financially dependent? Did they live with you? So when they get into the dependent, they being the CRA, it's just a facts-based consideration. So again, if you had someone that and again, spouse is automatically covered under this credit for sharing. But if you had, again, mom or dad living with you and living at home with you, to me, they're dependent on you. They're living with you. You take care of them. Now, again, circumstantially, you may still have somebody that's living with you that has enough income to use the credits. This is meant for mom or dad are living with you. They can't utilize the credits. Then those credits can be applied to your own personal tax return. So one of the things that normally what normally comes up here is okay, well, what's a medical expense? And it used to, I like back in again, I presented this for so long that Google didn't exist when I was presenting, right? You go, wow, okay. You're still a young guy. But Google didn't exist at that point. And so it was almost like a game. Well, does this medical expense, does this qualify as a medical expense? Does this qualify as a medical expense? And so I would bring this trusty book with me. Like I've got a tax book here that I utilize, a nice thick beast. And so I would bring the book with me and we could run through and decide what was a medical expense. Well, the brilliance is now we've got the internet. And so there's two ways of getting further detail on this. The first is this form, this publication called an RC 4065. So again, this is on the handout that Sandy's going to have for you at the end. But if you Google RC 4065, and I'm assuming that that's coming up for you.
Yep,
the very first hit on this list, right? You'll see here, RC 4065, medical expenses. Brilliant. And we can go in here and you've got this gorgeous publication that goes into every detail you could possibly want to read up about medical expenses. And it just lists, all the different expenses you can claim. It gives you calculations. Where is it at the back here? It's just anything you could think of. So what I've done is I've downloaded this already. I've given Sandy a copy of it. But again, it's super resource, amazing level of detail. Now, again, you can get into a level of detail that is beyond what this publication has, and at that point, it's just a research exercise. It's using Google, it's finding cases. You can get into the cases of things like people who have deducted hot tubs as therapeutic and what have you. And again, there's always going to be a case for something, but fundamentally, 99% of what you're going to want or going to want to understand is going to be in that publication.
Michael, are there any deductions in there that are particular to looking after someone with dementia?
Well, I would even I would use something as simple. And again, I'm going to get further to this in the presentation into attendant care. But I think what a lot of people are looking for is care providers. That's a huge thing, right? Is you know you know the mom or dad or spouse needs that extra level of care, and it becomes well, what's the attendant care situation? And so you'd use, say, like and again, an Acclaim day program. Someone would say, well, does that qualify? Well, yeah, it's an attendant care. Another interesting one is well, Mike, you talk about the disability tax credit, and we have to pay someone to go get that done. Can you claim that? Yes, you can. And the funny thing is I don't know that that was ever outlined in this in this RC 4065, but recently, again, the CRA has gotten better and better at how they process these claims and the letters that come back. And one of the most recent letters that I got back for a client actually said in a paragraph in the letter, and please note, you have to pay a medical practitioner to get this credit. Any expenses related can be claimed. So yeah, I think in context, I mean, the very simple ones are prescriptions and the like. But again, I think it's the attendant care is the big one, and I'll get a little bit more into the attendant care later on in the presentation. One other aspect of medical expenses that I just like to highlight, and again, it's not really in the context of most of the folks here, but someone you might know this might apply to. But although medical expenses are generally a credit in the case of, again, non-refundable, so if you can't further it, right, if you've reduced all the taxes based on all the non-refundable credits you have, you can't further deduct the medical expenses, except in a case where you have a family where the employment income, so again, this is more related to folks that are working and are in a lower income situation, where family employment income is less than 28,000, you can actually generate a refundable amount of up to almost $1,300.
Michael, I have another question. Do you want me
Yeah,
to save them
absolutely.
till the end,
No,
or
I love this. Actually, kind of makes me feel like we're right. And
someone's
actually,
listening?
Sandy, and well, it's not even that. It's that, like, again, in as much as, at least with the radio show I used to do, I'd be able to play some music, and right, I didn't know. Right now, I'm in such a void right now. So hearing that voice is just it's nice. So yeah, absolutely, please do. What do you got?
So someone asks, she says she's caring for her mom who lives with her.
Yep.
Can she claim medical expenses even if it's her mom who's paying for them?
Well, so yeah, what I would get into is, so first and foremost, if mom is paying for them, if she has enough income on her return to utilize the credit, it would get applied there first. So then we would go to, well, if mom doesn't have enough income to utilize the credit, yes, I would be applying those on your tax return, even if mom is paying for them. Because again, I would suggest that if mom's living with you, there's other things that you're contributing. And so mom is in fact dependent on you, which allows for that utilization of those credits. And so it's interesting. I'll get into this a little bit with the disability tax credit, because CRA has been a little bit more inquisitive on the, well, how are they dependent on you situation? And where that really comes out is they can now link it back to the disability tax credit. And so I'm gonna, when I get into the disability tax credit here, I'm gonna show you the form. And I did actually have a client recently that was quizzed by CRA on a particular section of the form. So the linkage now is there to be able to say, well, if you aren't able to demonstrate the dependence within the disability tax credit, they would have the entitlement to deny you the ability to claim mom or dad's medical expenses on the return. But again, I'll show you that, and I'll actually show you the area in the disability tax credit certificate that applies to.
And so here's part two. How about if mom wasn't living with you? Can you claim those?
Again, it goes back to that dependence issue, right? So if mom isn't dependent on you in any way, no, right? So it's that terminology dependent. And so similarly, again, and that goes back to similar circumstances to the caregiver amount, it's how do you demonstrate that dependence? And I'll show you the questions when I get into the disability tax credit form. I'll show you how they're utilizing that form now to establish the right to use those credits.
Thank you, Michael. Michael, I did miss an earlier question. May
Yeah,
I
certainly.
go back to the
Absolutely. Oh
first
my
section?
gosh.
I
Yeah.
apologize, but
No, certainly. Certainly.
so this is the first. If the spouse's income is $5,000
Mm-hmm.
and they do not use their full personal exemption,
Yes.
can the residual amount of the exemption be transferable to the higher income earning spouse?
I failed to mention it in that way. That is exactly how it works. So if you use the basic personal amount, so again, go back to it, it's $12,298, and you have an individual that only has $5,000 of income, you would then note that that individual has not used up $7,298 of their basic personal amount. That is the amount that would transfer over to the other spouse as a spousal amount. Perfect.
Thank you.
I'm glad. Thank you to whoever asked that question, because that is a nuance that I didn't really, right? I just said if they have zero, but yes, if they have anywhere from zero to $12,297 of income, whatever isn't used on the one spouse's return can be transferred to the other. Perfect. So the disability tax credit, again, I'll call this maybe the crescendo, if you can say that with a tax presentation with a straight face. But the disability tax credit is the big piece to this presentation. And to me, this has always been the piece that not everybody has been aware of. As time has gone on, it has gotten better advertised. As time has gone on and people are networked. And again, I go back to the days where before the idea of social networking, the idea before Google and what have you, how would somebody get information on the disability tax credit? Because again, the concept is a tax concept. Well, I don't generally talk to people about their medical conditions, their parents' medical conditions, or anything to that. And then when somebody's at a doctor, if someone's being diagnosed with dementia, it's not usually the doctor that's going, hey, but did you know there's a tax credit for that? So the combination of the two has never really worked particularly well, but as time has gone on, I have found that each time I present, there's been a slightly higher percentage of people that were already aware of this credit. And so why it's important here is it's pretty much an automatic that anyone that is dealing with Alzheimer's, anybody that is dealing with dementia, they have a severe and prolonged mental impairment. And so in that context, the disability tax credit applies, full stop. So just to get into the concept of the disability tax credit in a more general sense, the tax credit looks at a series of basic activities and determines, is the individual able to perform these basic activities? So mental functions necessary for everyday life, feeding and dressing oneself, speaking as to be heard, hearing as to understand, eliminating, walking. I use a example of my uncle. My uncle is deaf. There's no question. We would, he did hear at a point in time. His hearing got worse and worse and worse and worse. And he got to the point where he could not hear. And so one of the things that he did, and it was at my suggestion, I suggested to my aunt, I said, look, he qualified for this credit. You should apply to that. And so it didn't require all of these aspects to be satisfied. It just required one. And so he had to go and have an audiologist test his hearing, document it, fill in the forms. It was sent off, and he qualified for the credit. And so right? So go specifically to the situation that we all at this session are in is let's talk about mental functions. And so as time has progressed with this credit, we've gone from what used to be a one-page document to a comprehensive document that really then allows the individual who's assisting with the application to look at the definitions and say, well, you know, does this credit apply to this individual? And so these three items that I've got up on the screen here, you know, abilities related to self-care, health and safety, abilities to initiate and respond to social interactions and to common simple transactions, memory, you know, basic personal information is name and address, material of importance of interest, and problem solving and goal setting and judgment. These are all the mental characteristics that they're looking for. Now, again, I say that in the terms of what the government has defined. You know, there's a form that has to be filled in by a medical practitioner. And whoever is going to be filling in that form, I mean, it's likely going to be someone who has known the patient for a long period of time or a reasonable period of time to be able to identify that this individual is dealing with dementia. This person is not able to care for themselves, is not able to function in everyday life based on that, you know, deteriorating mental function. So in that context, the doctor is not going to go to these specific definitions. There's an area of the credit form that the doctor fills in to establish that this exists. So when we get into the finer details of the disability tax credit, and I'm going to bring up the form in just a moment, you know, the period of impairment should be in excess of 12 months. And so that's mentioned specifically in the definition of the credit because, you know, you could have an individual that say, well, I broke my arm. Can I qualify for the disability tax credit? Well, no, you broke your arm will heal. You're assuming you're back to normal in a couple months. You're not impaired. You're able to do all of those basic activities that were mentioned. The claim must be accompanied by Form T2201. I'm going to get into that in a second, and again, you know, glad if you write down T2201. Again, it is mentioned in the handout that I've given to Sandy, as well as some of the other documents that I provided to Sandy. So again, which requires a doctor's certification. There's a whole host of different individuals that can be specifically tied in to filling in this form depending on the situation. And so I'm just going to show you here another document. So again, back to our friend the Google. So you recall that we were dealing with the RC 4065, which was for medical expenses. If instead I put in RC 4064, you'll find the very first thing that Google comes up with is not some you know, obscure part to a machine that you'd order from. No, it's the RC 4064. It's the disability related information document. And so again, beautiful document in the sense of it really does a strong job of explaining all the tax measures for persons with disabilities. So there is a lot that's beyond the scope of what I'm talking about today that it details. So again, you know, is this guide for you? You know, the criteria for disability tax credit and how to apply, other related tax credits. So again, some of the other things that I've identified and other disability related information. As the years have gone by, this publication has gotten better and better. And so you'll see all of these items, right? So you can see the caregiver amount that's in there. It talks a little bit about medical expenses, again, noting that that other publication that I talked to has a lot more on it. Some fantastic stuff in here. So again, I'm just kind of scratching the surface with this. You know, there's a lot of depth to what's available in the two publications that I've noted. So you'd say, okay, great, Mike. So you've mentioned this disability tax credit. Why do you think it's so important? What's so great about it? Well, here's the thing with the disability tax credit. I've introduced these other credits like the basic personal amount, the age amount, what have you. So the disability credit is $8,576. So what does that mean? That means if you had an individual that applied for and received this credit, if you took that 15% on which the tax is reduced, and actually I like to use 20% because this credit also applies provincially. If you take 20%, so if you multiply that $8,500 amount times 20%, that's a $1,700 tax reduction to an individual that's claiming it. $1,700 is an enormous amount to somebody who has a disability. It can make a huge difference to their situation. I don't think I'd have anyone that would argue if they were handed $1,700 that they couldn't figure out something to do with it. So I point out that simply by applying for this credit, receiving the credit, and then putting it on the individual's tax return, that is saving the individual $1,700 in taxes. I'll get a little bit, I've got a few more slides on this. And so what I'll point out is that you might have an individual that can't utilize the credit. And so then where does that lead us? I just note here, there's an extra supplementary credit for persons under the age of 18. I just simply mention it as a matter of fact, in case you know anyone that might apply to. So any unused portion of the disability amount may be transferred to a spouse or supporting individual. So again, just like the basic personal amount can be transferred, just like the age amount can be transferred. So you could have a spouse that could be entitled to one of these credits but doesn't have enough income to use it. The credit can be migrated to the spouse's return or supporting individual's return. And so this is where I get into, and I'm going to show you this here. I'll get right into the form. Let's get over here. So if we look at the form, so this is it's a 6-page form that, again, by simply Googling T2201, it will be the first item that comes up in Google. So very easy to find, download. Again, Sandy has copies. The most up-to-date version of a form is the 2018 version of the form. There's not right. So again, if you're looking at the screen here, or you're looking at a copy of the form, you always want to make sure you're using the most up-to-date version of the form. So if you were to look in the bottom left corner of the screen, and again, it's probably smaller on your screen, but it says T2201E, and then in brackets 18. That means it's the 2018 version of the form. If you tried to use the 1999 version of the form, it would get rejected because, again, it's one page and it doesn't give any details near what's needed in today's age of filing these credits. So you look at this form and you've got all sorts of different sections that have to be filled in. Step 1, fill in the parts that apply to you. So again, when it's you, it's the individual that is afflicted with dementia. So that individual, right? Information about the person with the disability, right? Then you've got the second section. And I point this out because this is where we get into who's claiming the disability amount. So let's use a spouse, right? So you've got an individual that is disabled that can apply for the credit. They have no income. They are not going to be the individual claiming the amount because the amount's going to be transferred onto the spouse. So in here, you would tick the box that says the person with the disability is my spouse, right? Okay, answer all of the questions, answer the following questions. Does the person live with you? Yes. If yes, what years? So it gets into, well, okay, if you're going to claim the credit for this individual, do they live with you? Well, that's great. So if you have somebody, if you have a parent that's living with you and they cannot utilize the credit can be transferred to you as their caregiver. And so again, that's a very valuable credit. It's $1,700 reduction in taxes. And so you get into this, does the person live with you? Well, yes. And so you identify. Where this becomes important is If you answered no to question 1, because we would always get this, and someone would say, well, am I allowed to claim this for mom or dad on my return? Well, yes, but this is the caveat. If the person doesn't live with you, then it's how are they dependent on you? And so you'll note in here where it says, does the person with the disability regularly and consistently depend on you for one or more of the basic necessities of life, such as food, shelter, or clothing? So you could end up in a circumstance where you have an individual that they've got more than enough money to support themselves for the rest of their lives. And one would then argue and say, well, does that mean that they need food, shelter, or clothing? Again, CRA would want this to be filled in to be able to detail how you're helping them with that. Are you going to have somebody that's cooking their food every day? Well, that would apply to food. Clothing, well, are you dressing them every day? Maybe there shows the dependence. But if somebody can't fill in this section of the document and be able to suggest that the individual is dependent on them, then CRA is going to deny that credit. And so, deny that credit transfer. And so I point this out because it has come up more recently. I wasn't seeing this as enforced in the past. I did have a client this year that received this questionnaire back. I don't know, maybe it hadn't been filled in sufficiently or wasn't detailed enough, but CRA pushed it back and said, well, you've claimed this credit, please explain. Please detail how this person is dependent on you. And so, in the past, it was a little bit more vague. Now it's very specific. The rest of the document really gets in. Actually, sorry, I'll point out one other section, section 3. And I note this, there's further slides on this, but a lot of times we'll find that, we'll have this presentation and people will say, well, geez, I wish I had known about this 5 years ago because I would have claimed the credit 5 years ago. I would have had the form filled in 5 years ago. And now I've missed out on 5 years worth of this credit, which, times almost $1,700 a year, again, because the credit's indexed, that could have been, over $8,000 in mom or dad's pocket, or just to be able to help with their care. The way this form works is the practitioner who's filling it in actually notes the date of the impairment. So if it's documented that the individual, was demonstrably impacted by dementia 3 years ago, they'd put the date 3 years ago. And so what it allows is, one, it allows you to tick a box in here that says, once the eligibility is approved, do you want to be able to have this apply to the returns? But the second part of it is it does allow someone to go back and adjust for prior years. So the interesting thing is, and again, anecdotally, I know this works. I had a consultation with somebody that, somebody that I consulted with a number of years ago, and it was very brief. We talked about a number of things, and I don't even recall this coming up, but we talked, and I reconnected with them about a month ago. And the first thing that happened when we got on the phone was they said, before we do anything, we just want to say we can't thank you enough for mentioning how the disability tax credit worked. And I said, okay, I don't recall. And they said, well, you had said that if we got the form filled in and we sent it with a letter to say, dear CRA, I can't remember whether it was mom or dad, but had this, I think it was dealing with dementia for this long a period of time. Can you please go and adjust their returns accordingly to claim the credit for the years in question? Just a letter, right? Nothing formal, the letter with the credit. And they said to me, they said, Mike, CRA sent a check for over $15,000 because they went back and reassessed all those returns. And all it took was them getting the form filled in properly and sending a nice courteous letter to say, could you please adjust the returns accordingly? So it's something that's that simple. And again, I say it's that simple in the sense of there used to be people that would help out with these things, and they would charge a commission, and they would charge, you know, commission of upwards of 25% of the tax recovery. And again, I mean, people do what they got to do, but I looked at this and I go, this is something that anybody that's listening to this can do on their own. All it takes is taking the form that I've noted here, taking that form to the medical practitioner, having them fill it in, filling in the piece about the taxpayer, sticking a stamp on an envelope and putting the form in and putting it in the mail. What you get once you've done that is a letter. Here we go. Are we seeing the letter on screen?
Yep, you're good. Dear
Right.
Madame.
Dear Madame, we're writing about your eligibility for the disability tax credit. And again, this is client, got it filled in on their own. My instruction was take the form to the doctor, get it filled in, put it in the mail. We have completed a review and determined that you are eligible for the DTC for 2019 and future years. And again, in some cases, again, if it's backwards looking, it's backwards looking. And so, you know, there's a number of other aspects to this letter because they were trying to claim it. They were looking to claim it on the daughter's return. There were a number of other aspects to this letter, but the fundamental was they got the letter back and it said you're eligible, and it's as simple as get the form filled in and mail it to the address that's noted, and CRA will send a response saying you're good or we need more information. And so the letter does, you know, a great service to the individual, and it allows them to move forward and get the credit processed. Once that letter is in hand, it's in CRA's system forever going forward that individual is eligible for the disability tax credit. So the form only has to be sent once. It is then on file with CRA. And if that person qualifies for the credit for the rest of their life and they live another 20 years, they would get that credit for 20 years in perpetuity with nothing other than having to put it in one line of the tax return each year. Actually, there was, is the need more, is there another letter here? Dear Madame?
Yep.
We're writing about your eligibility for the disability tax credit. We cannot determine eligibility at this time because the medical practitioner has not provided mandatory information. So again, say you did it on your own, right? You took it to the doctor and for some reason the doctor doesn't do it properly. And again, the doctors know about this. They charge for it. It's usually you know, it's not covered in any plans, and they're usually looking anywhere from $50 to $150 to fill in the form. But yeah, CRA will occasionally send these letters back and say, well, we don't have enough information. And so then it's a matter, and again, this is what happened with my uncle that was deaf. He got one of these letters back and it said, well, it's not clear enough. We need more information on this. We need a copy of the actual hearing test. Great. So sent more information in. But the fact of the matter is once the credit certificate is filled in and sent, you will get one of two responses. You're good, or we need more information. Typically, if somebody is in the position where they are looking to claim the disability tax credit, they're often right, there's the ability actually in the RC 4064 that I've mentioned to somewhat self-diagnose whether or not the situation warrants the disability tax credit. So, I mean, from that end is I can't say it enough, is all it takes is you to take the form to the doctor, and it's as simple as that. Sandy, are there any questions coming in on this one? Because I know there's...
No, you're good.
No? Okay.
Yeah, you're good. Now we normally take a little 5-minute break. Do you want to keep going? I don't know how much
Yeah,
longer.
I'm pretty close. I mean, and again,
Yeah, okay.
that'll allow people that, if there's a few other questions, then people can stay on, or we can get together 5 minutes later. But I think I can kind of take this to the finish line so that if people want to exit, they don't have to wait an extra 5 minutes.
Okay. Oh, sorry. I've just got another question. Is the
Yeah.
disability tax credit going back 5 years automatic, or do I need to refile?
How's this? 10 years. So generally CRA only keeps your, and again, sorry, that's a great question. And again, I'm maybe a little off my game tonight, but 10 years is what they will allow you to go back. So normally with a tax return, CRA uses a term statute barred. And so usually once a return is gone for 3 years, CRA can't go back and adjust it, and you can't go back and adjust it unless CRA thinks something fraudulent has happened in the return. With the disability tax credit, CRA has taken a compassionate view of this credit. And so they will allow up to 10 years back on this credit. So again, I present that if once the form is filled in, if the form has been filled in and it says, the individual was markedly restricted in say 2013, that is where I would send a letter with the credit and say, please adjust the individual's return for all years they are eligible from 2013 through to the present, and that should be enough to get it done.
Thank you. Another question. Does the form work now that the tax due date is gone? How does that work?
Absolutely. So and I strongly encourage people to do this tomorrow, right? Because what happens is, and again, CRA, I don't often say poor CRA, but CRA is in a bit of disarray right now, right? Just like everybody's businesses or anything else, everything is very strange. And so a lot of CRA had shut down, and you've got a lot of people that are working from home, and it's obviously unusual times. But what's important is you put that credit certificate in the mail as soon as you have it ready to go. It doesn't go along with the tax return because all the tax returns are generally e-filed these days. So if you send that filled in form tomorrow, let's say, under normal circumstances, within 12 to 16 weeks, you'll get that letter returned, right? That says you qualify. And so the reason why that's important is you'd say, well, okay, it's the end of November. Let's hope that you'd get a response by the end of March. And so for the next return that you're filing come March, you'll be able to put the credit on. You'd also say, well, wait a second, Mike, but that, I didn't get it for 2019 or 2018. Well, that's again where the letter comes in. Please apply for this for any of the prior years for this individual.
Great. And just a reminder to always take a copy of anything you send.
Yeah, absolutely.
And
I've got a slide for that at the end. The thing with the taking a copy, again, the original has to go. So you got to be careful there is you have to send the original document. You take a copy for your own records should you need to refer to it. But if for some reason in the vast number of documents that CRA gets, if they lose it, you'd be obligated to go get a brand new version because you'd have to get an original. So, but again, I have not run into instances where CRA has not received and processed these things. It's a fantastic process. It for all of the complaints someone could have about CRA and government and what have you, this is a great program and it has run well for years and years. I've even had times where I've had to have where CRA's called on a credit like this, and the people that even work in the department that processes them, they are compassionate. They are looking out for the taxpayer in this case.
Good. I've got lots more questions coming in. Do you want
Great.
them now?
Do it.
Okay.
I should be respectful though. I mean, maybe everybody else wants to stretch their legs, and if maybe, Sandy, if there are a number of questions, maybe we should take the break so that, because again, I want to get to those questions. I want to make sure that because again, these are valuable questions. There may be a little bit of an afterthought in my world, but for everybody else, they don't deal in taxes every day. So I'll leave it with you. I could go straight through, but we can take a 5 minute
Okay, you know what? Let's do a quick 5-minute stretch. I have 8:03. We'll be back say 8:10.
Perfect.
And we probably won't go anything past 8:30, I would think.
No, probably not. Sounds good.
No.
See you in a few.
So are you going to leave a screen up?
Yep.
Okay.
I'm just going
You
to
just
mute
leave that up.
myself yeah, just leave it up, and I will yeah, once I'm back
Oops.
into the screen, we can start it back up.
Okay, super.
Great.
Great, thanks.
Sandy, I'm checking out the questions here because I can see them on my screen.
You can see them now?
I can see them. Well, you had me. I was focusing on doing my thing. So
Yeah,
I mean,
no, that's okay. Do you
I'm
want to?
happy. I'm happy for you to. Yeah, I like you interviewing me. I like it that way. It's good, right? Again, it gives that interaction. It makes me feels a little bit more normal than just reading questions. So yeah.
Yeah.
Do you want
Okay. Well,
to go to the questions, or do you want to continue? I'm glad to go either way.
sure. Well, let's do some of the questions. If someone else was claiming the disability tax credit, such as a spouse, they die, and
Yep.
an adult child would like to claim it, would you need to reapply?
No, but what you would need is that first page that I showed you with those questions on it, and that's where the CRA is going to get into. So again, so say you're the, it's your parent, and suddenly you're going to go claim the credit. The credit's going to appear on your as the individual's tax return, and CRA is suddenly going to go, well, who are you claiming this for? Who's your dependent? And so that first page, I'm going to go back to that first page of the disability tax credit form. That's going to be the important part. Are we looking at it here?
Yep.
Right?
Yep. You
So
got it.
that's where this page will become important. And so it's more likely than not that what would happen is if you're the individual that's claiming the transfer, you're going to get a letter from CRA saying, well, explain to us the transfer. We need you to fill in this page of the disability. So you wouldn't have to do the full form, because the rest of the form really deals with what the medical practitioner is filling in. It's just this page that becomes relevant.
Thank you.
Okay.
Number 2, my husband was diagnosed with Alzheimer's only in December 2019.
Yes.
Does this mean I cannot submit the tax credit form till December 2020? If allowed, would it be eligible for 2020 tax year or not till 2021?
Well, it'd definitely be 2020 tax year. I would try and claim it for 2020 or 2019. I would, again, if the practitioner is diagnosing it in December of 2019, so it's clearly established at that point. It's just that the impairment is going to be longer than 12 months. It's worth sending it in. CRA can draw the conclusion as to whether they want to allow the credit. I'd leave it with CRA, but I would send in the form noting December 2019 and try and get the credit for 2019.
You. How about if the person was diagnosed out of Canada in the year 2013 and moved to Canada 3 years ago? Does she have the right to apply for the past 3 years?
So as long as you're a taxpayer in Canada, right? Because the credit is on a Canadian tax return. So if you, let's presume you had somebody who qualified that was dependent on you, but they weren't resident of Canada, they wouldn't be filing a Canadian tax return that would then have the credit showing on it. But as soon as they are a resident of Canada, or sorry, they're a tax filer in Canada that qualifies for the credit, at that point, that person could qualify for the credit and the transfer could take place. So in that case, if the individual moved to Canada, and again, I think you said 2016, you would be looking at 2016 and going forward. The challenge that I think you'd find is if the person was living outside of Canada prior to that, how would the medical practitioner fill in the form appropriately? Because the medical practitioner that's here would only probably be able to deal with that for the individual from that date going forward. Knowing that if 2016 was the first date that you'd be applying for the credit, you'd really only need the form filled in from 2016 going forward anyways. So I would presume that you would have a practitioner here that would be able to at least fill in to that extent.
Okay, thank you. We've got 5 more questions that have come in. I think we'll if you want to do a little bit more of the presentation, then I'll bring up the next questions.
Sure, absolutely. Okay, so just to right where this leads to is attendant care credits. So actually, I got to get my presentation back up here. So attendant care credits. So you've got a case now where somebody needs either attendant care at home, nursing care, some form of institutional care. In order to claim attendant care credits, right? Attendant care credits fall under the scope of medical expenses, but it's a very specific medical expense in the sense of it requires the disability tax credit to have been accepted with CRA. So if you had someone and you said, well, okay, someone coming in and helping with mom or dad or spouse or anybody at home, I've got someone coming in to help them. Can I claim attendant care? I would say, well, stop. You can't claim it if you don't have the disability tax credit. So we've seen folks that have claimed attendant care without having first gotten the disability tax credit, and CRA bounces those. But CRA will then reinstate it if the person goes back and gets the disability tax credit for the appropriate year. So I point that out because if somebody is having an attendant come in, to me, that's somebody who is likely to qualify for the disability tax credit. Right. So I think the careful consideration is some might want to use it and say, well, I have someone come in and clean for mom or dad. Well, but it's cleaning, and so that wouldn't qualify it if they were helping mom or dad with various other things that they needed to be able to live. Yeah, you need the disability tax credit to be filled in. So I point out the third point: the attendant cannot be the spouse of the person claiming the credit. It'd be a great income split. That's what people would use it for. And so specifically CRA took that one and said, look, we don't, right? You could have somebody who has a lot of income on their tax return, but also qualifies for disability. They could have their lower income earning spouse try and be their attendant and move income. It defaults out. So where I go with this is now there's two options for claiming these attendant care amounts, and it's a what's better for the taxpayer. So option one, claim the disability amount, right? So our $8,500 credit amount plus a maximum of $10,000 in attendant care. Or option two, don't claim the disability amount. Now again, you've qualified for the disability credit, but you just don't claim the $8,500 credit, but claim all the amounts paid for attendant care costs during the year. So you go, okay, well, why is that rule in place? I'm not totally sure, but it just presents a calculation that someone has to do. So they basically have to look at it and say, do we have over $18,500 of attendant care costs? Then we would use option two. If we had less than that, say we only had $15,000 of attendant care costs, you'd pick option one, because option one would allow you $10,000 of attendant care plus the $8,500 disability credit, whereas option two would give you zero disability credit and $15,000 of attendant care costs. So again, tax software specifically identifies attendant care costs, and it automatically does these calculations. And again, as I mentioned, attendant care costs are considered medical expenses and so are subject to the same threshold amounts. So again, that 3% of net income or $23.97 threshold that I'd mentioned previous. Again, another, just so you know, if somebody had an attendant specifically that allowed them to be able to earn employment income, so again, you had somebody coming into the home and that allowed the person to be able to work, that can actually be used as a tax deduction as opposed to a tax credit. And again, that goes back to marginal tax rates, right? All of the non-refundable credits that we've been talking about are only calculated at a 15% rate, whereas if you had somebody who was earning income, and again, it's really outside of the scope of what we're talking about here, but in case you knew somebody that needed an attendant in order to perform the day-to-day duties of earning income, it can be a straight deduction. Home accessibility tax credit. Again, this one's been around for a few years, and this is not to be confused with the home reno credit that took place a few years ago. Home accessibility tax credit allows a certain amount of renovations for taxpayers that are over the age of 65 or qualified for the disability tax credit. So if somebody spends anywhere up to $10,000 on expenditures that basically allow the qualifying individual to gain access or be mobile or functional within the dwelling, or reduce the risk of harm to the qualifying individual within the dwelling, there's a credit for that. And so I pointed out because, again, there's a lot of mobility renos that are being done in homes that would qualify for this credit. And so again, for any individual that can qualify for this, again, if you had a $10,000 renovation at that 15% tax reduction, you're getting essentially a 15% discount on the renovation by getting that tax credit back. So again, they need to be permanent fixtures, building materials fixture, right? So, and again, with the cost of building materials during the last 8 months just escalating, it's not too, it doesn't take too much to get up to $10,000 of expenditures in order to do some of these renos. Involuntary separation. This is just a very simple concept that I like to introduce, but again, a lot of times what we have is if we have two spouses and one is dealing with dementia, oftentimes they will live in two separate residences. And so what that causes is it can, again, it's a cost strain. And so what is allowed for is the concept of involuntary separation. Allows for certain tax credits to be calculated separately from the other spouse. So normally, say in the province of Ontario, you may or may not be aware of what's known as the Ontario Trillium benefit. It's an amount that's paid monthly, and it's an indexed calculation based on net income. And a number of other factors, but generally it's calculated on family net income, which generates a payment to the family once a month. And so what happens is if you take two individuals and you combine their incomes together as a family, it reduces the amount that qualifies for that credit. Well, with involuntary separation, what it allows for is it says, well, these two individuals, although they're married, they can qualify for this Ontario Trillium benefit on their own individual income, as well as accommodating for their cost of living costs. So they're paying for two different residences. So it really allows each of them to be entitled to their own Ontario Trillium benefit. So it's quite a big deal because, again, that calculation can erode the Ontario Trillium benefit quite quickly. And when you're paying for two sets of occupancy costs, it's obviously very expensive. And so the ability to get this Ontario Trillium benefit multiple times based on involuntary separation is very powerful. The one thing that I'll point out, and again, Sandy, I think I did give it to you this time, is there's a form that gets filed with Service Canada. So again, I want to point out, you'd say, well, geez, Mike, if we do that though, what about the idea of transferring credits? Well, the returns are still filed as married, so it still allows for the transfer of any of the credits that I've mentioned earlier on in the presentation, but it only then affects these Ontario Trillium benefit credits. And so there is a form that's a Service Canada form, and it is called an ISP 3040. And Sandy, I've given it to you, so if you want to pass that along. Previously,
Yep.
I didn't have the form, but does everybody see this here? Statement: spouses
Yep.
or common law partners living apart for reason beyond their control.
Got it.
Great.
Yep.
That's right. Very simple document. And again, it also, my understanding is it also does impact the guaranteed income supplement. So, very simple form, but all it's really requiring is you to identify, who you are and essentially where you're living, right? And what the reason for living apart is. And so, in context of what we're talking about here, explaining the dementia, and again, you could even cite, that the person's been diagnosed and a disability tax credit has been filed and what have you, just to kind of provide additional evidence that this isn't just somebody just filling in a form for the sake of trying to get additional credits. Because again, we all know there are the occasional individual that does that, but not the folks that are here at this course. Representing a taxpayer. this is pretty straightforward. Again, a lot of times we're dealing now with individuals that can't deal with their own taxes. And so there's no ability for them to contact CRA on their own behalf. So to be able to talk to CRA on behalf of another taxpayer, there's a form. It used to be called a T1013. It is now called an AUT-01. And so again, I will show you the form here. It is a form that just basically is to be filled in. Now, when I show you the form though, you will say, well, but Mike, at the bottom of, right? So authorize a representative for access by phone and mail. What you'll find here is at the very bottom of the form, it will say, you know, have the individual sign it. Well, you know, you have some people that can't sign. So you'll note here, I am the administrator, executor, liquidator, power of attorney. So again, power of attorney is identified in this form. Where in the past, again, we get into power of attorney concepts and CRA wasn't really well equipped to deal with it. They are getting better at this. And so what I would suggest is if you did need to, you know, look out and deal with some, you know, work on behalf of an individual, the best thing from my perspective would be file this form with the power of attorney document. And even better, and again, it's not really identified here. This is where I would probably send a second copy of the disability tax credit, just right, an additional copy that really shows that the individual has dementia. Because I always look at this and I go, well, it's great that you have a power of attorney document, but how does CRA enforce that you're actually in a position to enforce the power of attorney? Right? I know in a case of one of my clients, it required 2 medical opinions in order for anybody to recognize the power of attorney. It was just how it was scripted in his documents. But for CRA, just because you send a power of attorney document doesn't mean that that person has necessarily authorized the power of attorney. So some sort of other relevant evidence, i.e. a copy of the disability tax credit, would go a long way to, you know, getting CRA to understand that the individual is not going to be able to sign the form to give you authorization. This has always been a challenge, and it's especially in the dementia area, because again, a lot of folks aren't capable of signing anything anymore. Last one is just the Ontario Senior Homeowners Property Tax Grant. Very simple. It's an income tested item for people over the age of 65, that if they paid property taxes on the principal residence, they can qualify for a $500 grant. And that $500 is available to anyone with any family with under $50,000 of income that's paying property taxes, but not more than 60. So
Do you have a
if you
slide for that, Michael? Do you
Oh,
have a slide for
sorry.
that?
I'm looking at my slide and I'm thinking, well, this slide looks great, and I did not jump back to. I didn't jump back. Do you see it now?
Yes, thank you.
Okay, sorry, I jumped all the way past this. So I had this beautiful slide here, and then yeah, just identifying at least 64 years old and an Ontario resident, December 31st, 2020. And you'd say, well, Mike, it's a 64 there, but you're applying for the grant for the following year, so you will be turning 65 in the year that you receive the grant. And so, yeah, again, so it's $50,000 of family income or less qualifies. Any family with over 60,000 won't qualify, and if you're between 50 and 60,000, that $500 is indexed. And so you'd say, well, this sounds all very complex, Mike. What would you do? There's a box in the tax return and you tick the box. And if they don't want to give you the grant, they won't give you the grant, but I would just tick the box. If you're not sure, tick the box, apply for the grant. Additional resources, I can't say this enough. What is CRA into? They love receipts. They want receipts. Oftentimes you will have returns processed for years and will never have to submit a receipt. But again, it's kind of similar. Actually, I think about how I have to file my any sort of medical claims, right? Now the system is you file the medical claim for the amount, and occasionally the online system bounces back and says, oh, we want a copy of the receipt for that, right? So same thing with CRA. You file your tax returns for years, you may never have to submit a receipt, but they always have the ability to ask for the receipt, and the burden of proof is always on the taxpayer. So keep all your medical expense receipts. Medical expenses include medical equipment receipts. Again, I always encourage you to keep a copy of the disability tax credit certificate just for your own reference in case you have to refer back to it. Receipts for nursing home care. This next point, receipts for amounts paid to attendants, including social insurance numbers. If attendants, right, if you have an attendant that's coming in and you're paying them and they are not employed by you, in order for you to deduct that receipt, and when I say deduct, sorry, utilize that receipt as a tax credit, CRA wants to be able to tax that person on the other side. So just having a simple receipt with someone's name on it with no identification on it, CRA will bounce that receipt. So, you know, in many cases, if you're dealing with a service provider, you're going to have an actual invoice that's going to have the business number of that care provider service. So no problem there. But if you're directly contracting individuals, yeah, CRA needs some identifier to be able to identify how they're going to tax that individual. And then, yeah, home accessibility tax credit renovation receipts. Great Google searches, Canada Revenue Agency, and again, they've really stepped up that website. It is, there was a point in time where I would have probably gone anywhere but the CRA website for information about how the tax system worked or any sort of credits or what have you. Their website has really become fantastic. It is really a great resource. We didn't get into guaranteed income supplement here, but again, I would, again, if you're not sure about guaranteed income supplement, again, it's pretty straightforward. Once you get into the program, it's indexed based on every year's tax filings. Again, we talked about T2201. You actually don't even have to Google disability tax credit certificate T2201, just T2201 is fine, RC 4064, RC 4065, that will get you where you need to get to. That's it. Except for
Awesome.
a lot of, again, I know we've got a lot of great questions that are coming, and so let's have at it.
Okay, thank you very much. That was great and entertaining as always. Okay.
As best I can when I can't get audience reactions, but Sandy, as long as I get the occasional laugh from you, let's.
Can you provide the correct wording for the letter to the CRA? And that was on the disability tax credit.
Yeah.
Do you still have to write that letter? I see there's a tick box now.
There's a tick box. I mean, you know, anybody that knows me is I'm a measure twice, cut once person. And so if adding a little nice covering letter just really solidifies it, the covering letter would I would have a covering letter that would go with the tax credit that would just simply say, please find attached the disability tax credit certificate for this taxpayer. Please note that the date of impairment was whatever the date. Please adjust the taxpayer's tax returns for all years starting at that date accordingly. Thank you.
Great, thank you.
It's very, again, there is a prescribed form called a T1 adjustment form, and I just look at it and I go, again, as a tax practitioner, I appreciate that form, but the nature of how this credit works, and again, the want for CRA to be able to give this tax credit out to the right people, that letter is right. Again, I go back to that anecdotal of that couple that I spoke with, and it was just that simple for them.
Thank you. Regarding the transfer of the tax credit, if a caregiver does not live with the person with dementia but pays for the living space, such as their mortgage or monthly retirement home costs, does this qualify the caregiver to receive the tax credit?
I would suggest that should, because again, that's a dependence piece, right? So again, you're going back to that section in the form at the front where you've got the question, does the individual live with you? And you're saying no. But then the second question is, well, talk about how that person's dependent. And at that point, if you're able to document and say, this person's dependent in the sense of I'm paying all of these costs, right? So it's getting into food, clothing, and shelter. Well, they're dependent on you for shelter. You're not necessarily, they're not sheltering under the same roof, but without your funds, they would have no shelter. I would suggest that that should work.
Thank you. Did you used to have to reapply for the disability tax credit every 3 years?
No. So what would happen is, and I've, again, in practice, maybe seen it 2-3 times, is that credit. Now again, you could consider, I think the last time I saw it was I had one for somebody who was a minor. And when that individual, when the minor hit 18, CRA actually sent a letter saying that after this year, the individual will need to reapply for the credit. But outside of that, no, once it's in the system, it's in the system unless CRA sends a letter saying otherwise. So unless they had some reason to think that somebody could have, I'll say, recovered from the impairment, yeah, it's in the system. So no, it's never been a 3-year rule. Not again, not in the last 20 years.
Thank you.
Yeah.
What if they were impaired before the formal diagnosis? The doctor would need to make the assessment and extend the T2201 date back?
Well, but the challenge is can the doctor fill in the form to suggest that that was the case? Right. So
Yeah.
right, like that's going to be the challenge. So say you had somebody that they didn't live near a doctor, or they couldn't get them to go to the doctor, and they hadn't been to the doctor for 3 years, and then you brought them to the doctor that day. The doctor only has that day to be able to judge based on, they don't know what the last 3 years has been like. So that would simply be the challenge there, is what's the doctor able to reasonably document in the DTC application.
Thank you. Do I need to keep a paper receipt, or can I just scan it or take a picture of it?
How good's your computer? I right? No, the CRA, right? Like, again, you're only doing that for your own use, so it's just a matter of what's your system. I mean, if you were to use any sort of evidence, right? So let's just park the disability tax credit certificate, because again, recall that they've got to have the original. If you were dealing with any other documentation, say it was receipts for medical expenses, CRA does not need the originals. Scanned copies or facsimiles will work with them. And again, a lot of what we're dealing with CRA now is uploads to their system. So if you had to submit 50 medical expense receipts, we would be taking copies of them and we'd be scanning them up to CRA.
Great, thank you.
Mm-hmm.
If I take care of my parent in terms of looking after their tax return, preparation, filing, administering all their home services and payments for that, looking after their investments, finances, lawyers, which is not the same as food, clothing, would these qualify as valid arguments for being able to claim the disability tax credit?
I think you'd be at the mercy of the form. So I think you'd put all of that into the form and see how it goes, right? That's again, you've got somebody on the other side that is going to read and interpret.
Yeah.
And so if it doesn't fit what they feel, right? And again, knowing CRA, if you send that form and someone's tasked with looking at it, they're going to look at it and say, well, okay, it says food, shelter, and clothing, and I don't see enough here about food, shelter, and clothing to allow for the transfer. Yeah, it's quite possible they deny. Now, if it's me, I'm still going to try, right? You know, if it takes you 15 minutes to write a few paragraphs as to why you think that they're dependent, absolutely. I mean, the worst that happens is they send you something back that says, no, we don't like that. But the best that happens is, oh, we're good with that, and there's, $1,700 tax reduction every year.
Great, thank you. At what stage of dementia will the disability tax credit apply? Mild, moderate, severe, or terminal?
That's a great question, and I don't know. Right? Again, it goes back to that slide that I had about memory, right? And so is the individual able to function in the context of those specific memory? Actually, I'll bring it back up here. That to me would be the Just gonna scan back through here. So if I go back to share, this slide, right? You're seeing that adaptive functioning.
Yeah.
That's really that's the guidelines that we have, and so that's the challenge is the doctor is going to fill in the form, and they're going to fill in the form in the context of what the individual is. That's where a CRA gets the form, and they might say, well, it's too mild. We're not allowing it to process, and so then you'd be looking at another year, and you'd send the form in again and say, well, okay, now here's all the conditions. There's not an absolute baseline on this, and that's the funny thing is I look at it as you could have two totally different doctors fill in this form, and one could write an incredible description of somebody with a mild case, and suddenly that person's getting disability tax credit. You could have someone that's more severe, and the doctor doesn't write enough of a description, and that person could get denied. It's really, they've tried their best with the form to try and take the subjectiveness out of it, but there's always going to be a subjective aspect of it.
Good point. Thank you. For the home renos tax credit, do you need to provide proof that the renovations have been recommended by someone from, say, the health authority, like the LHIN, like a occupational therapist, that's made a formal on-site assessment versus something you feel would be good to have?
I've never seen anything that says that it's got to be recommended by anyone. So in that vein, again, you go back to the definitions that are there. It's saying, does it allow for better mobility within the home? So again, if you were to have, and I always go to the context of somebody's getting audited, right? And when I say audited, it sounds really drastic. It's you get a letter that says, hey, you claimed $10,000 of expenses. Please send us receipts and tell us what those are. And so if you're going to send in things like shower rails, or you're going to send things in like, and again, I use it in the context of dementia, things that, prevent someone from accessing doors, right? So those specific trick knobs to be able to allow somebody who's able to manage the doorknobs to be able to open them, but not, if you have all of these things that are receipted that are very clearly identifiable, there's no reason why anything needs a recommendation. I think the challenge would be is if you said, well, oh yeah, we renovated, we did a gazebo. Well, okay, somebody on the other end is going to audit and go, well, what was the therapeutic aspect of the gazebo, or how did this make mobility better? I think it's pretty self-evident. And if it was me and I wasn't sure that it was going to show enough evidence, say I was putting a wheelchair ramp in and I did it myself, but I bought all the lumber, I might say, well, okay, I better take a couple pictures of what I built here, right? And that gets into the challenge of when you do it DIY, it's going to have to be very much more specific on the itemization of what you're doing. Whereas if you hire someone to do what's needed to be done, right? So you'd end up having a little bit more documentation of here's what it is that's been put in. Using the wheelchair ramp as an example, you'd have evidence of materials that are being purchased, but as well as, hey, we built you a wheelchair ramp.
Great, thank you. How long do you need to keep your receipts for? How many years?
7. So I say that to the letter of the law, right? So 7 years is what you're supposed to. Generally, CRA is never going back more than 2 years. But that said, don't throw your receipts out, because if they change their contacts, right? Say they saw something in 1 year they didn't like, and they said, well, we'd like to go back another couple of years. And you said, oh, they usually only go back 1 year. I should have kept, right? No, 7 years is what you're supposed to.
Good to know.
Mm-hmm.
Last question of the moment. During the current pandemic, does the caregiver have a benefit?
So perfect. And you know what? I'm going to be straight up with you on this. I didn't realize this until today. But again, this is all the different things that are happening out there. All things are being introduced ongoing. In the accounting world, March, April, May, June were were very difficult because things were ever changing. Can you see my screen that has disability related information on it right now?
Yes, RC
Great.
4064. Yeah.
Great. So here's this. The Canada Recovery Caregiving Benefit. Okay. This was only introduced very recently. And so the challenge is here when you read about it, and I'm going to suggest that this is as familiar to me as it is to all of you, other than the fact that I see many of these subsidies ongoing right now. This is like many of the other subsidies, the rules continue to change. And so I simply point you in the direction of it. But this recovery caregiving benefit, again, has some very stringent conditions to it. So you're looking at conditions, right? Who can apply? So you end up in a position where your very first condition is you are unable to work at least 50% of your scheduled work week because you are caring for a family member. Well, right away, I think that's going to eliminate a lot of people, right? Because if you looked at it and said, well, geez, you know what, there's 3 of us that are sharing the duties of looking after a specific individual. Yeah, we each take, 1 or 2 days out of our week. Well, they're not missing 50% of their work. So boom, they're out on this credit, right? But what this is doing is it is subsidizing somebody who's missing a great deal of work for a family member that needs support. And so you see here, you were caring for your child under 12 years old or a family member who needs supervised care. So again, this is very relevant to our scenario here, in the concept of the regular care services are unavailable due to COVID-19. So again, I point this out, but I have my doubts that there's going to be a lot of uptake with regards to maybe the folks that are on this presentation. It feels to me that it's more targeted to dealing with childcare.
Thank you.
Okay, but yeah, so Canada Recovery Caregiving Benefit is there, and again, I'm going to point out that this was kind of a late item because I wasn't aware of it, but it's not in any of the slides and it is not in my handout. So Sandy, I just maybe mentioned this to you that so that even if you just note Canada Recovery Caregiving Benefit, people can easily find the link to that.
Thank you. Got it.
Yeah.
2 more questions have popped in. Which doctor should write the tax credit? Geriatrician or family doctor?
I would generally go with whoever's better acquainted, right? Like, I mean, oftentimes family doctor would be able to go back further in time, right? So again, I go back to that whole point of, well, when did this first take hold? Usually you're being referred into another doctor. Well, that other doctor you're referred into, that's the first evidence that they have is the first time they meet or what have you. Whereas the GP may be able to go back further. Are they less qualified to do so? I don't think necessarily. I mean, the GP can write these things up, and they often do.
Thank you. One more question. This is our last question for the evening. Does Ontario?
And you know what? If another one comes up, I'm not going to hold you to it. Okay, it's good.
Okay. Does Ontario have a caregiver benefit outside of the COVID government funding one?
That's really a low note to go on because I'm not sure on that one.
Yeah,
the Ontario.
Yeah.
Well, I'll be honest with you. The Ontario stuff hasn't been really widely advertised. I mean, my wife brought one to me the other day about something for kids or kids in education. I'm like, oh, I didn't know. So I got to be honest with you on there. I don't know that for sure. If anything, I kind of doubt it. But again, look at this one for the feds that, again, I mean, I think this one was only announced in the last couple of weeks. So yeah, none that I'm aware of, but
yeah,
again,
we're not.
Ontario I feel like a lot of this stuff on Ontario has been a bit buried. And that's not me trying to be critical. I just think the feds get most of the airtime, and that's where all this stuff tends to land. So I have to be careful not to say no, but I'm doubtful.
Yeah, I'm not aware of any. And I know Nova Scotia has one, a provincial one, and I know there's advocacy through the Canadian Association of Retired Persons through CARP for
Yeah.
an Ontario one, but nothing at this time.
Okay.
And nothing else has come in. So I think we are done. And I wish to say, here, I'll pop up again. I wish to say thank you very much, Michael, for, there we go. Whoops. Thank you
Oh,
very
you were
much.
almost there.
Yeah, thank you very much for a fabulous presentation. Always good information. And I think everybody's going to be racing to their computers and printing off those forms pretty soon.
Because everybody loves being in front of their computers these days. Oy.
That's right.
This
That's
is,
right.
you know, and I'd like to thank everybody for being patient with me tonight. This is a whole new thing. You know, I've done this presentation so many times, and to do it in this format, again, unique. I'm ready to do it again like this because come the spring, I think we're going to be doing it this way.
Yep, we'll be doing it again this way in spring. So thank you, everybody.
Awesome.
And we will, yeah, and there's a little exit poll when you leave, if you don't mind filling it out. And yeah, thanks and good night, everybody.
Awesome. Thanks, everybody.